All right, welcome everyone to today's Title Topics webinar. These are ALTA's free presentations we offer every month on issues important to title professionals. I'm Jeremy Yohe, Alta's Vice President of Communications, and today we've got a great webinar lined up that's going to take a look at the market outlook for the remainder of this year and into 2021. And then we're also going to have a nice discussion on how innovation and technology are impacting the industry. Before introducing today's speakers, I do need to touch on a few housekeeping items. A copy of today's presentation can be downloaded from the GoToWebinar handout section. You should see that in the GoToWebinar panel there on your screen. All participant lines are muted for today's presentation. If you do have a question, please submit them through the questions box. We'll hold a little bit of time at the end for Q&A. And as an added benefit, we are recording today's presentation. Now, the recording will be available on Alta's website at alta.org/webinars. That's alta.org/webinars. I do need to thank the F&F family of companies for sponsoring our Title Topics webinars this year. Their support allows us to provide these educational opportunities free of charge. And with that out of the way, let me introduce our speakers today. We're fortunate to have not one, but two analysts from AM Best. Joining us are Ann Modica and Brett Islami. Both are associate directors with the ratings firm. And on the screen, you can get a little bit more information about their background and their expertise. And with that, I'll turn the presentation over to Ann and Fred.
Okay, great. Hi, everybody. My name is Ann Modica, and Fred and I are going to be talking to you today. I'm going to start off, and I'm going to talk to you more about the economic environment. I'm going to start off by kind of setting the stage with what we're seeing in the current environment, and then kind of go over some of the main macro components that are setting the current economic conditions, kind of the government's response that we've been seeing, then go over briefly some of the housing market indicators and the economic outlook kind of heading into the first part of 2021, some of the upside potential that we see, and also some of the downside risks. And then Fred's going to take over and talk mainly about innovation in the ratings process as well as the title industry, and he's going to hit on blockchain, remote closing and signatures, technology and cyber, as well as new insurtech companies. So to start off, here's the economic environment. I'm going to start off kind of by looking at where we are currently by setting the current stage. Can you go to the next slide, please? So where we are now, I'm going to look at the health situation that we're at right now, as well as the economic environment. So as you all know, we are still in the midst of a global pandemic. Millions of people have been infected and hundreds of thousands are dead. And unfortunately, more of this is still to come. The total death toll in September was about 200,000, and the predictions are by the beginning of the year, we're going to see about 400,000 deaths. And I kind of want to put that into perspective for you, because the first 200,000 deaths was reached in a span of about 7 months, and about 40 to 45% of those were in long-term care facilities. The next 200,000 deaths are going to happen within the span of about 4 months, right? And this is also taking into account what we already know about the virus, and it's probably not going to happen as much in the longer-term care facilities. We're likely to see it happen because of increased opening in the economy, as well as seasonality, right? I mean, a majority, we're in the fall and we're upcoming into the winter months, and a majority of the U.S. is going to be spending a lot more time indoors, which the virus thrives. So what started out as a health crisis in March quickly turned into an economic crisis. And, you know, we dealt with that by largely shutting the economy down. And that had huge implications, very drastic implications for both economic growth and unemployment. Second quarter GDP lost 32%, and we lost about 22 million jobs. We are starting to come out of that. The economy is being reopened with restrictions, and this brings its own set of issues. As mobility increases, so does the number of infections. I mean, you can just turn on the news right now and you'll probably hear somebody say, 39 to 40 of the states right now are currently seeing higher rates of infection over the last couple of weeks. And in places like New York City, where Fred and I are kind of close to, which were the original hotspots, they're also seeing increased closures in certain parts of the city due to higher rates of infections. And we're likely going to see that as we go into the fall and winter months in other parts of the country. So it makes it all very difficult to kind of give a path to the strength and the shape of the recovery. It's yet to be determined, and it's hard to do when forecasting right now is very dependent on the public health outcome. It's such a huge determinant of how successful the economic part of this works. So yeah, the path of the pandemic drives it all, and this just leads to a great amount of uncertainty. So here I'm just going to kind of get into the nuts and bolts of the macro condition of what we've seen in 2020. And I'm going to kind of give a little bit of a look back. This is looking at GDP, and GDP is broken down into four main components: exports, PCE, which is just consumer spending, investment, and government spending. And I want to focus on the purple part of the bar graph, and that light blue line is just headline GDP number. And so that purple part of the graph is consumer spending, and it's important because it accounts for about 70% of all economic activity in the U.S. And it has been strong and steady. I mean, before we got into this recession, we had 128 months of continuous economic growth, and that was on the back of the U.S. consumer. There was not a period of time since the global financial crisis that the consumer negatively impacted economic growth, and you can see that from the chart. I mean, it's extraordinary, but you can see that it all kind of comes crashing down into the first two quarters of 2020. And the other thing that's kind of interesting about this, I mean, it's kind of an aside, but I want to point it out. Typically in recessions, consumer spending it's usually not as impacted as something like investment is. It's usually pretty steady. And investment has been somewhat stronger. And, you guys probably know this. I mean, the one exception in this case is that housing investment has been doing surprisingly well. This has been aided by historically low mortgage rates. And some of these were in place even prior to the pandemic, low inventory and some other factors that I'll go into a little bit later. The next graph, so consumer sentiment. And I think this is a pretty interesting graph. So initially, consumer sentiment did drop pretty far in both March and April, which you would expect, but it's been making up some pretty good ground in recent months, and it continues to register gains. I made this graph like a week or two ago, and the October number came out, which is not on here. That registered 80, which is even higher than the September number. And however, I think it's pretty surprising, at least to me, that consumer sentiment is as high as it is, given the various uncertainties that we're going through right now, the economy, the election, the pandemic. I mean, all of these things you would think would kind of weigh on consumer sentiment. So it kind of had me thinking, and this is why I kind of interplayed unemployment on top of this graph. And I think it kind of answers the question. If you look at the job losses haven't been symmetrical. Job losses have mainly been concentrated, at least up until this point, with lower wage earners. I mean, those are the ones who've been losing their jobs. I mean, it kind of makes sense, right? They can't work from home. They're kind of in industries where they're client-facing, where social distancing isn't as likely as, kind of like a more professional setting. And their unemployment rate is about 21%. If you look at the rest of the people, if you take out the service industry, the unemployment rate comes back down to about 4%. The really scary part too about this is that the unemployment rate is starting to become a little more sticky. We're seeing longer periods of unemployment, as well as people being discouraged and leaving and not looking for jobs. So the recession has disproportionately impacted certain segments of the economy, and this is why I believe that the sentiment is not lower than I would normally expect it to be. It's just because some people just aren't being affected. Actually, I think I would almost make the argument that some people are actually being made better off, right? I mean, if you still have a job, if you're working from home, maybe you got the stimulus check, you're not spending $15 on your lunch anymore, you're not having to pay for gas. But I do want to point out, I think there's a caveat to all this. I think the longer that this goes on, it's going to affect people outside of the service sector, and we might see job losses in other segments that could affect the housing market and things like title insurance. So spending, I touched upon spending briefly in a couple of graphs before this. I'm going to just dig into it a little bit deeper because it is such a high part of GDP. So what I did is I indexed spending to 2019 in December. I indexed it to 100, and I just took the percentage change from month to month and looked at it that way. And so spending is broken down into two main categories, goods and services. So goods is about 35% of spending, and it's broken down into durables, stuff like auto and furniture, and non-durable, I don't know, think about gas, clothing, that kind of stuff. And then spending is the remaining 65%. That's stuff like housing, healthcare, discretionary spending, like going out to a restaurant or traveling. And as you can see, before the pandemic, it was really steady, right? It kind of like hovers around that black line, which is the 100%, the 100 index, right? It doesn't really move. But then, as you would expect, it takes this dramatic drop in March and April, and then you can see it recovers in April. With goods, actually, recovering much better than services. You can see services does recover, but it kind of like starts to flatline a little bit more in June and doesn't get anywhere near the December levels. And I think, we're not going to see services spending come back anytime soon. A lot of analysts don't believe that that's going to come back until late 2021 at the earliest, and that's 65% of consumer spending. This is stuff like preventive medicine, sporting events and concerts, brick and mortar stores, and you've seen a lot of big names go out of business like Barney's and Lord & Taylor, and this obviously has implications for retail space. But the good news is, right, goods have rebounded and spending levels have increased above the 100%, the 100 index level. And I think this is kind of, I don't know how long this is going to last, but I think it's a variety of things, right? I think the government gave people this kind of like free money, and they said, oh, well, I can't spend it on services. I might as well spend it on something else, right? And then I can't tell you how many of my friends have spent money on kitchen remodels and pools, home improvement, furniture for working at the office. So I think there's some of that going on as well. And this will probably come down a little bit, I think, as time goes on. I'm going to dig a little deeper into the job losses because I think this is important as well. We lost 22 million jobs in March. About 11 million of those have come back. So initially the job losses came back relatively strong, but they really stalled out in recent months, and I expect that to remain somewhat sticky. And a lot of economists do. The Wall Street Journal came out recently with a poll that half of the economists surveyed said that they don't expect the number of jobs lost to come back fully until 2023. And this is kind of striking because just 6 months ago, that same poll came out, and the economists expected those jobs to come back by 2022. And I mean, that's that's a pretty striking thing. Hiring has slowed, layoffs have become more permanent, and this bodes really poorly for the broader recovery, and it points to increased longer-term scarring. And again, the damage hasn't been equal. So, relatively safe for now. Out of the 11 million that are still unemployed, about 4 million are in the leisure and hospitality industry. So a bit of good news. We are going to have a strong third quarter number. Obviously, the economy opened up. Unsurprisingly, the number is going to go up. Estimates put the number at about 25 to 30% on an annualized basis. So don't get used to the good news. There are already signs that the recovery has seemed to have peaked sometime in July. And I'm going to be honest here. I mean, we're kind of in an unprecedented time, and the data points that we typically look at, it's kind of hard to find any trends. So what a lot of economists have been doing is been looking at these high frequency data indexes to kind of try to get a little bit of better handle on this. And when you look at those, you see stuff like credit card spending has declined. The job numbers have really weakened, with initial jobless claims have kind of like flattened. We've seen more of the layoffs becoming more permanent. The wave of business closures have definitely increased. And the Federal Reserve actually puts out this thing called the weekly index, which is actually kind of a misnomer because they put out information twice a week. But they look at these high frequency data points, and there is a definite weakening there. And the slowdown actually started before all of the stimulus started to end prior to July, which even had the Federal Reserve Chairman come out, Jerome Powell, at the beginning of October, and which is kind of an unprecedented move for him to come out and kind of not beg for stimulus, but just really make a strong case for it by saying that the government should provide more fiscal stimulus because the results would be tragic. He actually used the word tragic for providing too little support to the economy, because the risks of doing too little are much small. I mean, overdoing it are much smaller than doing nothing at all. And I think it's important to kind of put this on the perspective, right? Because it's a really powerful cocktail if you combine moderating job gains, waning fiscal support, an increasing number of COVID cases that might lead to another shutdown of the economy, even though it might be more targeted. You're going to really get a very negative cocktail there for economic growth. And I kind of want to highlight one point here, too, with regards to the lack of fiscal stimulus with regards to state and local governments. I know that's one of the sticking points. And I just want to point out that state and local governments account for about 10% of all of employment. So what state and local governments is doing so far is kind of like kicking the can down the road, hoping that they're going to get more federal government support down the line. And if they don't get it, since they don't have the revenue coming in as a result of these business closures, they're going to have to either stop services or they're going to have to lay off these employees. And the employees that you're kind of looking at are police officers or teachers or doctors at state and local hospitals. And when you're looking at that, you're kind of looking at people who can more negatively affect like the housing market, that who might more likely be able to buy a house or like lose their house if they lose their job. So I just kind of want to put that out there. And then obviously the uptick and all the kind of negative momentum that we have right now is concerning for the fourth quarter economic activity. So again, I want you guys to keep this in mind, that all the kind of the positives that I've been putting out there, I want to keep in mind that this growth is kind of occurring under the backdrop of all this extraordinary government support, right? And so I'm just going to kind of briefly go over what the government has provided to date. So there's two main avenues in which they've provided it. One is with the fiscal policy. To date, they've provided about 15% of GDP in support with two main programs. And these two, everybody probably knows, right? There's the CARES Act, and that is where they provided the individual checks for people of a certain income level, the expanded unemployment benefits, the increased $600 a week of federal support on top of the state benefits, the expanded time, some state and local government support, what else? The small business loans, etc. And then the PPP, the Paycheck Protection Program, again, additional loans to businesses, as well as some money to hospitals and virus testing. So that's what they've provided to date. A lot of that is stopped. The monetary policy, you can't even quantify this. I wouldn't even know where to start. I mean, it's been massive. I mean, basically, the Fed, I think the reason why Jerome Powell came out and kind of said, hey, the government has to do their part here is because they're basically out of bullets at this point. There's not much more that they can do. But what they've done so far is that they've cut the federal funds rate. They've provided increased liquidity by purchasing assets in the market. They've bought things like commercial paper. money market mutual funds, corporate bonds, as well as some term-backed securities, including mortgage-backed securities. And then they also lowered regulatory requirements to help facilitate lending and provide credit into the market. So here are just the rates. On the left-hand side, you see the federal funds rate. The Federal Reserve did cut rates by 150 basis points in March, which effectively brought the federal funds rate to zero. They have no more room to maneuver, and they have indicated that they do expect to keep it there for a while. And then on the right-hand side of the graph, you see the 30-year fixed mortgage rate, and while not directly tied to the federal funds rate, the mortgage rates were also subsequently reduced, bringing them to historically low levels, which boosted demand for home ownership. Here you can see the extraordinary run-up in the value of the Federal Reserve's total assets in the effort that they provided to the various markets. On the left-hand side is the total Fed assets. You can see that they jumped to about 4 trillion to over 7 trillion in just a couple of months, with all those different assets that I mentioned earlier a couple slides back. And then on the right-hand side, it's probably more interesting to you guys, is the Fed's holding of mortgage-backed securities. And you can see their run up there. They were starting to let them kind of run off their balance sheet when all of this happened. But you could see that they went to 1.3 trillion, and then they increased to about the 2 trillion that they are now. A majority of what they own in mortgage-backed securities are residential mortgage-backed securities, and just a really tiny fraction of commercial. So here are the housing prices. This is the Case-Shiller National Index, and the line is the run-up in homeowners' equity. The one real bright spot in the economy so far has been the housing market. Despite the pandemic, housing prices continue their upward momentum. The market does continue to be driven by the lack of inventory, the continued low rates. And I think some of the interesting thing too, right, is that it kind of brought a shift and a migration from some of the urban areas and the desire to purchase a home in a more suburban environment. By and large, buyers are looking for more space. Your home hasn't just become your home anymore, right? It's your office, it's your gym, it's your school. So if you're able to, you want a bigger home if you can do so. And also, at the height of the outbreak, many urban centers were the hotspot for the virus. Many, causing many to leave flee to the suburbs if they are able to. And I think this has to do also with many of the firms having a greater acceptance with the work from home environment. I think we're kind of on the beginning of this. I think it remains to be seen if this trend is going to continue once the pandemic ends. I mean, if you look at history, there's like a 200-year trend of people moving from rural and suburban areas to more urban areas, but who knows? I mean, the pandemic just might be the thing that bucks this trend long term. I did put this on top of the homeowners' equity just to show that how the lack of inventory and pricing affordability, does remain a concern despite the low rates. It is still a limiting factor for some people who do want to enter the market. Homeowners' equity at the beginning of 2020 was over $20 trillion, a pretty significant run up in the lows of the global financial crisis, where it was around, I don't know, let's call it like 7 to 8 trillion. And 70 to 80% of all renters would like to become homeowners, but most cite financial reasons as the reasons why they don't own a home. They can't afford the down payment, they're not making enough money, they have too much debt, etc. So here are the monthly housing starts. The number of homes on the market dropped to an all-time low, according to a recent RE/MAX national housing report that was issued for this September. The all-time low is the lowest that it was for the 13-year history of the report. Sellers have been somewhat hesitant to list their homes despite the high prices being offered because, one, they have to get a new home, and they don't want to sell it during a pandemic. You know, despite high prices, Realtor.com estimates that nearly 400,000 fewer homes have been listed compared to last year. You know, demand for housing is still really high due to ultra low rates, but the supply just isn't there to meet the demand, driving prices higher, as you saw from the last graph. However, this has led to increased home builder confidence. The National Association of Home Builders reported their third monthly increase in a row, and it's only the second time that confidence measure measured over 80, with an index reading of above 50 as signs of improving confidence. The index did drift below 50 in March and April, but obviously has recovered quite nicely. And then the other thing that we're seeing is there has been historical refinancing activity. Freddie Mac expects refinancing originations to stay at pretty high levels for the rest of the year, reaching 1.9 trillion before declining to 1.3 trillion next year. And this is obviously well above trend over the last 2 years, with 2018 at approximately 200 billion and 2019 at 1 trillion. And I'm starting to wrap up here a little bit. So my last two slides, what could go right, what could go wrong? So upside potential, the vaccine, right? The vaccine is kind of the game changer at this point. So we get a vaccine that is effective and trusted. It's taken by the majority of the U.S. public. And, you know, timing is always kind of variable on this. I saw yesterday that Moderna might be able to release this version of the vaccine sometime in late November or December for emergency use. But I think the cautious and conservative estimates that I've seen is that the likelihood of this coming out would probably be around mid-2021. And the Boston Consulting Group actually came out today and said that, you know, we're likely not to have this kind of change in behavior, and it's not likely to get to the whole public until like the end of next year. So even though I have this as an upside potential, I guess maybe, you know, it's just something to be aware of, that, you know, we're not going to kind of get out of this environment anytime soon. I think it's going to get better, but I think it's going to be incrementally better. Consumers remain resilient. What do I mean by that? You know, I kind of went through why I think the consumer is so important. Consumers remain resilient. I mean, the unemployment remains concentrated in the certain sectors that I said are already kind of vulnerable. And in that, I hope that sentiment does remain high and consumers continue to feel more comfortable to spend, that the longer that we stay in this, that they don't become fatigued by it, that they don't become more worried, that they're not like, hey, maybe I should be more concerned about this the longer that this goes on. And then also what could go right, I did these slides a little while ago. Broad fiscal stimulus is quickly approved. I don't think this is going to happen, unfortunately. You know, we all probably saw what was happening last night. I don't think this is going to happen, with at least until after the election. So the downside risks, unfortunately, I think these are more significant and likely, in my opinion. So, like I said, I did these a while ago. The second wave, we're already in it. You know, depending on what your definition is, we could be in the third wave. We're already seeing a great increase in the number of cases. You know, it's just a matter of time. And I think it's going to get worse as we get into the colder weather. Election uncertainty. I think this is kind of being downplayed by a lot of people right now. You know, there's a good chance we might not know who the president is on election night, or a couple days even after. I mean, I know the national polls are kind of widening out, but, you know, it hasn't been a national election in a really long time. It's all the Electoral College. And, you know, it really comes down to 6 battleground states, and those are tightening. And, I don't know what's going to happen. But, I mean, there is somewhat of a possibility that, like I said, we might not know who the president is for a while, especially with all the mail-in ballots. So the longer that this happens and the more uncertainty that happens during this period, the worse it is. And I went to a conference lately, and they mentioned the Bush or incident that happened in the 1990s. And I guess when this happened, the economy shut down for about a month and a half. And it was devastating. They said the economy went in a standstill. Businesses, stopped making decisions. They stopped hiring. Consumers stopped spending. And you have to see, and that was a much different time. A much different country that wasn't as divided, that's not in a recession, that doesn't have a pandemic. So I think that's something that we might want to hold our breath on until we get past that. And this is the one too, right? The stimulus remains stalled or limited. I think that's just the situation that we are in right now. And I think that's just going to be bad for us, especially for the economy. And it's because of these two things. The length of the pandemic causes consumer behavior to become anchored. They're more worried about it. The gloom becomes, part of, just part of it. They see it on the news, and the more it affects sentiment, the worse it gets. And then unemployment rate becomes sticky. I think we already see that happening. So then what is the recovery determined by? So I said this was one of my first slides. We aren't sure of the strength or the shape of the recovery, and you're probably thinking, thanks, that's very helpful. But I this slide, I'm just pointing out some of the factors that I think will be what the recovery will be determined by. And, and it's kind of hard to put, a point on this, but, I'm kind of try to let you think, let you know how I'm kind of thinking about it. So consumer health, what I mean by that, I don't mean their actual health. I mean their economic health. So the pace at which the consumer will want to and be able to resume pre-COVID spending patterns. Will they want to travel? Will they want to go into enclosed spaces such as restaurants and retail stores? I kind of always think back to this. This always kind of puts it in perspective to me. And I read this article right at the beginning of the COVID crisis. And one of the Federal Reserve chairs of the region had said this in an article in the Wall Street Journal. And I think he sums it up perfectly. He said, our economy will go back to the pre-COVID days when everybody feels comfortable going into New York City subway and holding the subway pole, right? So if you kind of use that metric, I think we have a long way to go. And the second one, the path of the pandemic, and I kind of touched on this, right? The interactions of increased mobility, how that kind of the increased mobility and the number of increased cases. I don't think we get past this until we get a viable vaccine or some kind of herd immunity. And then you have to worry about the safety of the vaccine, the effectiveness, will people use it, et cetera. Long-term scarring, I think this is a big one, and this is what the stimulus is trying to avoid, and the knockoff on economic effects. And this is what I think about. What has been the effect on investment decisions and hiring decisions? How have companies' balance sheets been affected? How are they going to be continuing to be affected? The longer this goes on, you don't have to worry about the multinationals, but how are the mom and pops and medium-sized businesses being affected? How's it affecting risk-taking? For businesses that remain open, will the cash flows, will that reduce risk-taking? That will affect longer-term productivity? Will they stop investing in new products and in new businesses? And then finally, the effectiveness of government policy responses. Will businesses take loans from the government, or will they just shut down? For consumers, will they save or will they spend the checks that they receive? Again, this just all adds to the uncertainty. And so with that, I conclude my portion of it, and I'm going to put it over to Fred.
Thank you, Anne. Good afternoon, everyone. It's a pleasure to join you today and provide some information on investors' perspectives on title industry and relevant innovation initiatives that industry has taken. I should note a disclaimer here, as I will be mentioning a number of companies or products that should not be interpreted as an endorsement of such companies or products. And also reference that on October 6th, we published our annual title insurance report, which addresses some of the the items that I'll be presenting to you in more detail. And we typically do this with the economic research that Anne is heading. And, it's actually a fun thing to do every year, because by the time this report comes out, we have already talked to the rated title companies, and we get fresh information from them, and we try to digest them for the reader of those reports. I should also mention that we do have a title insurance criteria that is and also an innovation methodology, which is available on our website at ambest.com. So I know most of the audience is interested in the way we looked at the industry's outlook. So through 2019 and first quarter of 2020, we maintained our stable outlook on title, mainly due to the factors that Anne mentioned, including favorable employment trends, which included low unemployment and moderate wage gains, consumer confidence, consumer demand for homes, solid housing market with record low mortgage and foreclosure rates. But comes March, and we all felt the impact of the pandemic, if not on our health, but on Dow and the markets. We saw more than 30% decrease in valuations, which led us to the conclusion that this pandemic could have major impacts on the housing market and title insurance due to lockdown and social distancing measures, rising material costs, again, labor and land shortages, higher home prices, and uncertainties about the government intervention. At the time, we reached out to all of our rated companies with a questionnaire, and this included also the title insurance companies that we rate, and basically stressed the investments in their portfolios. And we found that, for the title insurance companies, they also felt uncertainties, and they saw the situation to be very fluid, and that they had been monitoring their projections for 2020 month to month, which was a prudent thing to do. In April, actually, we saw housing starts fell 30% from March and 20% from a year ago. Permits were down about 21% and down 19% year over year. And housing completions fell about 8% from March and 12% from prior year. So in April, we revised our outlook because of all those factors to negative. By the end of the second quarter, there had been signs of improvements given to the government bailout and the declining unemployment to 8.4 in August. And in July, we saw the statistics, housing starts rose to 22.6 from June and up by 23 from a year ago. Permits were up 18.8 from June and up 9.4 from July of 2019. Housing completions also rose to 3.6 from June and up 1.7% from July of 2019. All of our rated title insurers saw that the low interest rates would continue to accelerate their refinancing. And also with the increase in housing starts, as Anne showed in one of the slides she had, the sale of existing home inventories and housing starts increased. So they saw no need to actually go back to the 2020 projections and modify those projections. And in fact, at least through the second quarter of 2020, they saw almost, I want to say, record counts on orders and revenues from the refinancing and new purchases. But there is still a lot of unknowns, as Dan was referring to. Market seems to be kind of stabilizing, but with the second round wave of COVID, the fact that companies are still laying off, and especially in the airline industry and retail. So those factors are unknown, and we are still evaluating them, and especially with the election coming up in June. In January, we will be looking at our outlook, and if there need be a revision, we'll make those in January. Now, if you don't mind, Jeremy, please go to slide 22 so I can talk briefly about the innovation. As every company knows, innovation covers a wide variety of efforts in an insurance company. First is upgrading and digitizing legacy operations. This is a big task that I'm sure every one of you have gone through and experienced when the legacy is replaced by new and innovative measures. The second is improving the experience of your customers, your policyholders, distributors, and employees. And the third factor is improving creating product and platform and service efficiencies. And this is the goal. This is the main goal that title companies are focusing on, in addition to the ease of business with their customers, their clients, and what have you. So I want to mention briefly, if we go to slide 23, the innovation scoring criteria that AM Best has taken for the past couple of years. As I mentioned, the criteria is available on our website, ambest.com. But we typically, when we discuss, when we have our annual meetings with companies, we'll spend some time and discuss the innovation with them. That focuses basically on 4 pillars on our input side of the calculation, which is basically leadership. How is the board participating in innovation? Is the initiative coming from the board? Is it distributed amongst the employees? Is it the executive management are involved in this? What's the vision for the innovation from the 3 items that I mentioned initially? And what's the rationale, which basically fall into that? And then we look at the culture. What is the level of participation by the employees and the management? How embedded those concepts of innovation within the corporation, within the company? What are the failures of innovation, and what lessons did they learn from those failures? And what are the innovation incentives and how it's communicated to the not only internally but also externally? So the next slide talks about the other 2 pillars, which is resources and processes and structures. Resources focuses on topics such as is there a chief innovation officer at the company or a similar position? Does the company have either internal or external personnel resources to innovation projects? Does the company have an adequate staffing and leadership? How does the company attract high level of talents? I mean, this is easily available by the job postings that the companies make, and you can actually analyze those and see what level of innovation the company is seeking to have. The next is the processes and the structure, which is how innovation progress is measured. Is it looking at your, let's say, expense ratio, or is it looking at other measures that other metrics that measure your progress in innovation? What teams are regularly involved in innovation initiatives? Is there an organized process to encourage employees to participate, and stuff like that? So with these 4 pillars, each one gets a either negative, neutral, or a positive assessment, based on which a score of 1 to 4 is applied. And then the next step to input is the output. So we look at the on page 20, on slide 25, we look at the results. What kind of results? And these are the examples that I list there. And I don't want to spend much time on this, but they get the same scoring, 1 through 4, and 1 being the minimal and 4 being the higher. And then at the end of the day, there is a formula for innovation scoring at AM Best, which actually is on slide 27, which adds basically the input plus the output, resulting to either a minimal innovation at the company level, which is under 12, to moderate, which is between 12 and 17, significant between 18 and 22, prominent between 23 and 27, and leader, which is higher than 28. So the next slide, 28, these are the 2 trends that exist within the overall title insurance industry. The first trend is enhancement of those existing and available technologies that the company have, and which is designed to integrate the overall real estate businesses. So in other words, you get to, let's say, Zillow, you find a house, there is a broker involved, to some extent this is done digitally, and then when you get closer to the inspection of the home, you go see the house, and the agent gets his information and provide it to you. So at this first trend, which is the enhancement, you see companies providing technology for overflow management to the title agents. So Qualia is one of those companies which provides the software which the underwriters on the title side, insurance side, can use, as well as the real estate professionals. And they get actually close at the end of the process. And the whole goal is, of course, facilitating the ease of business with the client. The other product that we have noted is a product called Modus, which I will discuss these later if we have time, allowing the realtor to offer title insurance through joint venture and partnerships. The other platform is providing underwriters a technology which will make them to remain competitive in a quickly evolving market like the endpoint. The next slide talks about the second trend that we see, which includes companies which displace the existing real estate business. In other words, they are rather independent, such as State Title, which is trying to reinvent the underwriting process. Companies like Jet Closing, which displaces traditional agencies through offering an efficient and tech-driven title closing experience, and residential brokerage that we are all familiar with, as I mentioned, Zillow, Flyhome, Knock, and Orchard, that are building end-to-end platform that span the home buyers' overall experience with buying a house. Now, I don't think I have enough time to go actually through individual companies that I mentioned on this list, but as you can see, some of these companies are providing platforms both for underwriters, for real estate professionals, and eventually with the e-sign and the RON and all that other efficiencies that exist already in the title insurance. And the other side is basically Truly Title, Spruce Title, State Title, are companies which are somehow trying to compete with title insurance companies. But overall, I think it takes a long time. It takes several years to see what happens with these platforms. I think Qualia and others have found acceptability within the title insurance and underwriting areas to be used. Some, the other ones, State Title and One Title, who have attracted a lot of investments from JVs and other investors. That has to be seen whether or not they're able to compete with the traditional title companies or will be taken over or be bought by title companies. I just have a few words to talk about the blockchain. Blockchain itself has been relatively a new technology, almost 25 years after the mathematical concepts were created. It was used in 2008-10 to create Bitcoin. But I think title was one of the first in the insurance industry to see that the potential benefit of using it. And as we remember, towards the end of 2019, both First American and Old Republic platform, created a partnership to launch their blockchain system that can be shared with other title companies and increase efficiency, reduce risk, and improve title insurance process. And of course, we know that with the use of technology comes the risk of exposure to cyber. And as we have mentioned in our report, we have contacted our companies or the rated entities, and we've discussed this in detail with them. And they all seem to be able to, with the hiring of, let's say, CISO or huge investments in technology, they've been able to at least internally protect themselves for the most part, and also again, since cyber insurance is available, I've seen companies buying cyber policy to complement the investment that they've made in their IT infrastructure. Forbes actually, yeah, that's all I have for now. I think I'm kind of at the end of my presentation. If there are any questions, I'd be happy to address.
All right. Well, thank you, Fred and Ann. Great information on the economic outlook and also the perspective on innovation in the title industry. As we mentioned, we will hold some time for Q&A. So if you have any thoughts you'd like to pitch to the speakers, submit them in the questions box. We'll chat for a few minutes here before we wrap up. Again, as I mentioned, if you missed any parts of today's webinar, if you think others would benefit from this, the presentation is being recorded and will be available on alta.org/webinars. You'll also get an email with a link directly to the recording. And one question we got back to when you were talking about refi volume and rates, any expectation, on the level of refinances and whether, mortgage rates will remain low in 2021?
Yeah, so Freddie Mac does expect for refinances to remain relatively high with regards to historical terms, but to come down from this year. Interest rates, so if you look at the Fed, right, they came out with a new inflation targeting mechanism, and I won't go into the long, boring details of it, but basically the nuts and the bolts of it basically indicate that they expect to keep the federal funds rate at the level that it is right now until 2023. So the implications for that for low rates are for low rates to be that low for that long. So yeah, I expect low interest rates to be in effect for a really long time.
Okay. And to add to that, Jeremy, I think, in our discussion with our title companies, they expect basically the same thing. They expect to see lower interest rates, increased housing inventories, and they're optimistic at least through the next first 3 quarters of 2021.
A question that came in, and Fred, this is for you. After AM Best revised their outlook, has your outlook for the industry changed since April, since that revision?
It hasn't. We typically change our outlook every January. The reason title was and other lines actually were revised in April was the impact of COVID, because as I mentioned, insurance companies, when they invest in all kinds of investment vehicles. So when we stress those investment portfolios for every company that we rate, we noticed that it may be prudent to revise some of the outlook, and title was one of them.
Okay. Getting some more questions coming in here. Not sure if who wants to take this one, but the question is on mergers and acquisition and landscape in the title industry. Are you seeing more activity, or are companies maybe a little bit more hitting the brakes a little bit, especially after the failed merger of Fidelity and Stewart?
Yeah, exactly. I mean, that kind of put stop on, or at least stop the title company acquiring another title company, because the regulatory environment for title, because the players are not many, and especially if the top players are trying to acquire, other companies, that might be an issue with the SEC and other regulatory bodies. Example of Stewart is a good example. I think, when they acquired the company, it was a complementary rather acquisition, not a competition type impact on the landscape.
Mhm. Do you guys look at, you mentioned Qualia and investments they've received. Do you guys look at the investments of venture capitalists, over the past year? Have you seen that increase, and does that, have a play into your outlook on the industry?
We don't monitor them closely, but we do watch, and we have alerts coming in on, any capital or joint venture information that these tech companies get. We actually have a unit which focuses on insurtech, and they're on top of these, and they alert us if there is anything major happening.
Okay. We're at the top of the hour. I've got one more interesting question, pitch that to you guys. And earlier this month, we held our annual conference, and one of our speakers was Kevin O'Leary, Mr. Wonderful from Shark Tank. And part of his discussion was the new GDP, and his GDP is the great digital pivot. And he shared, a couple of examples of how some of the companies he's invested in made the quick jump to provide their services online direct to the consumer. And it basically became their lifeline. The title industry, since COVID, has been really innovative to keep closings going and facilitating the transaction, whether it's a refi or home purchase, through, Fred, as you mentioned, digital closings, remote online notarizations. Are you seeing the traditional title insurers, pivot their innovation strategies, maybe as a result of some other companies like Stage Title? And if so, if you could maybe share a little color on what you're seeing.
Well, again, we rate a handful of title companies who are kind of advanced on their technology. So we're not, I'm not really exposed to the smaller title companies, how they do it. But again, this whole pandemic was an engine actually for every company to focus on digitization and to try to come up with efficiencies. And for the most part, I think, a lot of companies have been happy with the remote work that they've implemented for their employees, not only in title, but in every industry that I'm thinking about. But specifically, anecdotally, I had friends who have used, smaller title companies, and they've been happy with the process. They've been praising the efficiencies that have been created as a result of either remote or technology advancements that the companies have making.
Yeah, there was actually just a report on a survey by Closing Core came out today, and it was about consumer satisfaction sentiment on the closing process, and I forget exactly what the percentage was, but overwhelmingly they enjoyed the digital closing experience, and to your point, the efficiency that it provided. And actually, I believe in Pennsylvania, the bill's on the governor's desk, and that would make Pennsylvania the 29th state in the country to pass legislation allowing remote online notarization. Now that there's nearly every state that has some type of emergency order allowing for a remote online notarization or a variation, but that's definitely the trend that's going to continue going forward.
Exactly. The process is so easy and so common sense, especially in these day and ages, that you're wondering why they didn't do this, 10 years ago.
Mm-hmm. All right. Well, we already are a couple minutes over, so I apologize for encroaching on everyone's time. Again, reminder, you'll get a link to the recording. You can also always go to alta.org/webinars to access all of our webinar library. You can also find information on our upcoming webinars. Looking ahead, November 12th, we will have a presentation on the uniform closing instructions. And then November 18th, we will have a presentation on the election roundup. So you can actually go to alta.org/webinars to register for both of those now. And with that, that will bring us to the conclusion of today's presentation. I do need to thank F&F family of companies once again for sponsoring our Title Topics webinars. Take care, everyone.
Thank you.